Good morning, everybody, and welcome to everybody who's watching on the live feed this morning. Just a bit of housekeeping before we start. If there is a fire alarm this morning, it is real by all accounts, so just head out the way you've come in and make your way to the far side of the car park. Toilets, they've told us ideally to use the ones through the foyer and out the back in the other room, ideally with that. Okay, so to run through this morning's agenda, Richard is going to start with, I got that wrong, that's better. Richard will start with the main points of this election busting budget, but I'll let you be the judge of how busting that actually is. And then we're happy to invite Luke Pierce back from Rowan Dartington, who a lot of you already know by now is the stockbroker arm of St James's Place. Luke is going to go through, give us a review of the markets over the last 12 months and what the impact of inflation and interest rates have actually had, and give us a bit of an insight to where things might go for later on this year. And then after that, what we would like to do is give you a bit of a general update of really what's been happening in the press surrounding St James's Place, and really give you a bit of, clarity, on that. After the sort of 3 sessions, there will be an opportunity for Q&A. So if you've got any questions, please leave those till the end, and we'll answer as many of those as we possibly can on that. You will have all had a checklist given this morning. If we can ask you just to fill those in and hand them in on the way out, please. Okay, well, I hope you enjoy this morning, and I'll now hand over to Richard and we'll get started. Thank you.
Right, well, lovely to see you all. The 12:30 race will be starting soon, so we can all look over there. And the Yorkshire Showground, we always like to go there. We've been here before. It was pre-booked out. The Chancellor announced the budget quite early. So anyway, great to see you all, and Weatherby Racecourse got its own good things. Having had the Liz Truss sort of fiasco a couple of years ago, the budget was fairly calm as far as markets were concerned, and certainly as far as the stockbrokers and the investment managers we look at, everything was pretty much neutral, and you saw that by virtually no reaction in the stock market and the pound hardly moving at all. So from the market point of view, we didn't have a great deal of movement. What was clear is there were a whole set of winners, as there always are, and there were a group of losers. This budget was clearly aimed at workers, and national insurance having already gone down 2p from the autumn statement, which was taken effect from January. Another 2p, so 4p off national insurance is quite substantial for everyone working, and obviously the second bit will come in April 24. Child benefit claimants, the threshold was 50,000, it's raised, and the cutback is a bit later. ISA savers, which I'll deal with later. Second home sellers who are higher rate taxpayers, as a cut in capital gains tax. If you drink and if you drive, again, all the taxes have been held there. But the negative, I'm afraid, is all the pre-announcements and the freezing of allowances from when Rishi Sunak was actually Chancellor have continued to come through, but they weren't mentioned in the budget. So if you've had any form of increase in your pension coming through, you're going to pay more tax. And there are more and more people going through the threshold for just paying tax, and certainly the high rate tax. Estates for deceased, all I mean by that as losers is that the IHT threshold hasn't changed now since 2009, I think it is. Dividend people who have dividends, the threshold's actually reduced. Again, it was pre-announced in the autumn statement and last year's budget, not mentioned this time. Anyone that has unearned income, obviously, doesn't, and pensioners don't benefit from national insurance, so cuts in national insurance are wholly irrelevant. And for many of you here today, I'm afraid it's going to get more expensive to go at the front of a plane when you turn left. It's going to cost a bit more in taxes. And I don't think there's many vapors here, but my daughter hasn't picked this one up yet. Horrible habit. But vaping, there's going to be some sort of tax on that. And interestingly, if I go back to pensioners, we're seeing, I think, John and I, there's almost a two-tier sort of group of people in pensionable age. There are those, well, everyone's had pretty substantial rises in, obviously, the state pension, 10% last year, 8.5% coming through. And if you are in gold-plated government-based schemes or wonderful gold-plated defined benefit schemes with no caps on the increases, again, I'm seeing a lot of those clients saying, this is great, the cash flow is really positive, and although the thresholds haven't gone up, we're fine. On the other hand, with about a 20% increase in costs and inflation for the last 2 years, those people who either don't have substantial pensions or whose pensions are capped or in the defined contribution world are in a very different boat. So it's not as simple to say pensioners are better off or they're worse off. It really is very unique to where you are. But the simple fact is, unfortunately, that we are at the stage, I think I said this time last year, the OBR, the Office of Budget Responsibility, had forecast that the tax take was going to be the highest since 1948. They've come back on that prediction, so by 0.1 of a pence, by 2028, I think it is, it's going to be just about the highest level of tax since 1948. So we are in big government, which we talked about a few years ago. We are at big levels of tax. And that, in a way, is a precursor. Now, Luke's just said, what are you going to talk about, Richard? Because, frankly, nothing much has changed. So I am going to speed through this, because apart from national insurance and the UK-based ISA and the CGT on second properties, very little really has changed for you. So I'm going to whip through this. As always, I'm just going to tell you the facts and then what to do about it. So thresholds unchanged, frozen till 2028, as I've said. And we are going to soon see potentially the state pension be higher for new people going into pension age. It's about 11,400 at the moment, where it will be from April 24. And you're soon going to have, if these allowances don't go up, basic pensioners having more coming from their state pension than the tax threshold. Well, how's that going to work? Who's going to pay the tax? Is everyone going to have to do self-assessment? Who knows? And this is the effect of these allowances being frozen. Again, if in the household one of you is under the basic allowance for 12,570 and the partner is not a high rate taxpayer, you can transfer some of that allowance. I had some beautiful occasions recently where the lady of the house has now got to state pension age and wants her allowance back, which is quite funny, because it will help her income and drop her husband's in that case, or the other way around. So just be aware of that, and you can go back. Nothing new there. We talked about it all the time. The thresholds for the 20, for the 40 and the 45 are all as they were. Anyone over 100,000, it's the equivalent of a 60% tax hit as you go from 100 to 125. Not a lot you can do if you're in pensioners. You can do things with pensions as you move in work and salary sacrifice and all sorts of things like that. And then the starting rate of tax, again, if you don't have much income, maybe not at paid pension age, and with interest rates much higher, you only need 20,000 in a bank giving good interest of 5% to be earning £1,000, which is the personal interest allowance. So this allowance, where you've got the starting rate of tax at 0, is only relevant if your pensions are really under 12,570. But there's quite a bit of scope there, should you need it. And then this is the interesting area. A lot of you will have had in the last few weeks your pay-as-you-earn coding allowance. Get them out when we meet you for our reviews. Let's check that their assessment of how much interest you've earned in the previous year is correct, because this is how the revenue are going to get you back if your interest is over £1,000 for basic rate taxpayers, £500 for lower rate taxpayers. It will be through your coding notice. So look at your 22-23 certificates of interest, see if that tallies with your pay-as-you-earn coding notice, otherwise speak to us. Not too worried about last year. I think going forward, many of you have more than £20,000 in taxable accounts, and therefore your interest is substantially more than £1,000, and therefore you are going to owe HMRC some tax. And obviously if you're a high rate taxpayer, it's £500. And the dividend allowance, again, it wasn't really covered in the budget, but the dividend allowance is dropping from £1,000, coming down from £2,000 down to £500. So again, many people are going to find that they're paying tax on their dividends as we move into the new tax year. So you can see this sort of threes of all allowances. It's called fiscal drag is the proper term. Stealth taxes are what all the press call it, is just going to force more and more people to be paying higher levels of tax. And it's something that you've really got to watch quite carefully. So for your tax return as we come up to the end of the year, for you monitoring how you're running your taxable wealth in shares and in bank and building society accounts, do look at this very carefully, see if you can move some from one to the other, and then let's look at how we can potentially minimize the tax. The first is the most obvious. You shelter your wealth legally from the taxman. You start with ISAs. We've already had from the Treasury he called it the British ISA. I think I prefer that, but they call it the UK ISA consultation. You can see here one of the big sort of headlines was the British ISA coming in. It's not going to come in on the 6th of April. That's the first news. The consultation doesn't even end till the 6th of June. It takes me right back to the year I started practicing as a wealth manager in 1987 when PEPs came out, and you may remember it was 2,400, but I think it was something like you had to have 540 in a UK stock or a UK fund. So how we're going to do it, I suspect, will be like that. I suspect there will be an allowance where you've got to have 5,000 of 25,000 in a UK stock or a UK qualifying fund that PEPs used to say the underlying fund had to have 75 or 80% in UK stocks. It's not been met with huge praise, and from our point of view, and Luke may well touch on this, I think all that may happen is clients may adjust their existing ISA portfolio to possibly have slightly less UK stocks and then have more to take advantage of being able to put 25,000 into their ISA rather than 20,000. But the more you can put in, the better. It is as clear as that. There are many of you here today who the revenue are not interested in, who have very substantial sums of capital because you've maxed your premium bonds, you've done lots of old index-linked certificates from National Savings, which you can't do anymore. You've maxed on all your ISAs as you've gone along, so you've got very little taxable wealth. And if you haven't done that, do it by the year end. I've not got a little sheet in front of you, but there's notes if you want. And obviously, you do get hold of us as we get towards the end of the year. We will, as we always do, write out to all of our clients with taxable portfolios right at the beginning of April 24 to make sure you get that money in right at the beginning of the year, not at the end of the year, and therefore you've reduced your income either through interest or through dividends, you save tax. So do it earlier. And then for the beloved grandchildren, children, you've got junior ISAs, you've also got LISAs, lifetime ISAs, where you've got the 9,000 allowance. ISAs have become overly complicated, which is one of the criticisms, but there are lots of ways that you can do this. The negative of junior ISAs, obviously, is that the youngster at the age of 18 can get hold of the money. And I've got to be careful what I say because maybe people that are listening, but we've had our first ever independent 18-year-old very clearly indicate that that person doesn't want to do what the person's grandparents are indicating. But that is unique. I have to be very clear. That's the first one ever. But that highlights that there is a disadvantage to sheltering a lot of wealth in the name of a child when they get hold of it at 18, and you've just obviously got to be aware of that potential risk. Other ways of saving tax, mainly for workers, is clearly the whole pension route. You can fund your own pensions until you are 75. If you don't have earned income, not pensions, earned income, you can only put £2,880 in, but the government will put £720 in. But a lot of our clients, particularly with generous pension schemes, recognise their children or grandchildren don't have generous pension schemes and do something themselves. The other point now, as we move out of defined benefits, where most people retiring, unless you work for the government, don't have a guaranteed pension scheme into defined contributions, is what happens at death. And we're now getting very well versed. If you've got a defined contribution pension scheme, they're not part of your estate, they are inheritance tax free, and we don't have to wait for probate. So 99% of the time we have made sure the dependents, the wife, the husband, the children, have that pension transferred before even probate has been granted on all the taxable side of the estate. So there are some significant advantages of the defined contributions. And as we've been banging on, and clients, since Frank Field brought this legislation in 2002, I think it was, the ability to fund other people's pensions in your family, I wouldn't dismiss. Who knows what's going to be around for your grandchildren or your children when they retire. State pension age is already moving up from 60 ladies to 65. It's now 66. It will be 67. It's already going to go to 68. So the ability for you to be able to put money into your family's pensions, I wouldn't understate. So a range of moves for you to make, particularly the old independent taxation for married couples. Who's got the wealth? I still see the wealth held in the family the wrong way. Shall I say the higher worth taxpayer keeping too much money in their name, when actually if they put more of their wealth in the spouse's name, the spouse may only be paying a lower rate of tax and therefore saving substantial amounts of tax. Venture capital trusts, again, are available. Premium bonds, we've had lots of interest. The rate just has dropped this month to 4.4% for premium bonds. For high rate taxpayers, I think they are still very attractive, but really I wouldn't put less than 30,000 in. But again, all of these measures, ISAs, premium bonds, VCTs, pensions, EISs, are ways of saving income tax. And as those rates are frozen, as your incomes rise, you're paying more and more. Marriage allowance, the zero starting rate, all the things I've written down here, absolutely essential. So the capital gains tax, well, if you thought that was all bad news, this is even worse. I'm sorry. It's going to become a problem. It was 12,300 last year up to April 23. This year it's 6,000 up to April 24. From April 24, it's only £3,000. That's the amount of capital gain you can make each year before paying tax. The one really good point is the tax liability is currently only 10 and 20%. It's effectively like a marginal rate of tax added to income. And we reminded you last year, and as we approach an election, as John said, when Labour were last in power, capital gains tax was charged at 20 and 40%. One minor bit of good news was obviously the reduction for the higher rate taxpayers on a sale of a property, because you pay 18 and 28% on properties within 60 days of selling your second property. The 28 charge is coming down, as we've said here, to 24%. So a lot of areas being squeezed here, and you really do need to make sure you are active with your shares, with our portfolios. We are making sure categorically we have minimized your uncrystallized gains as you move forward into a period where you are only going to have 3,000 next year. And as we said last year, I'm afraid the bad news is I think a lot of you are going to have to get used to and accept you're going to have to pay a bit of capital gains on some of the growth in your wealth. And the dilemma is you only pay a capital gains tax if you've crystallized a capital gain. So do you sell something voluntarily to voluntarily pay some tax? It's a dilemma, isn't it? On the face of it, you'd say no, but then the question is, well, what's the point of having capital if you can't touch it? Is the tax tail wagging the dog? And certainly the general advice, and John and I need to get very specific, is we think once people get into this and when you look at your overall wealth, those with substantial taxable portfolios probably are better off paying 10% if they can to keep a lot of that portfolio available. So this is something that we're going to have to talk about. Clearly, if you're funding your ISAs from taxable portfolios, we'll try to do that and minimize and keep you within your 3,000 band, and obviously transferring assets between spouses and everything else. So it's a big area that is hitting what I call just normal Middle Britain for the first time. And I put at the bottom here the ONS, Office of National Statistics, website read life expectancy. What am I on about? Well, I'm feeling very well, but I've put on here, it's a bit tight, so I'll have to, you wouldn't believe it, I am 61, so I've put myself in there, I'm male, and this is me. It says I'm going to die at 85. Well, what am I doing? What am I telling you this for? Well, we actually use this. We are regulated or directed by our internal people to sort of look at this, particularly, if I go more relevantly, to a 75-year-old lady as an example, which is this. Because if we're suggesting someone pays capital gains tax to maybe save inheritance tax, it could be selling a second property by the sea. It could be selling a load of shares and giving the proceeds away. Well, you've got to live 7 years to just save inheritance tax. So it's quite a big thing for a 90-year-old to voluntarily pay capital gains tax, to then cross their fingers and live 7 years. Otherwise, they could face paying both. So here you've got the example. That 75-year-old actually has got a really good chance of living 7 years, according to the ONS. I think I'm going to go back. I'm just going to remind myself. My dad was 97, my mum's 90. That's a load of nonsense. I'm feeling far. Now, why do I say all of those things? Because the last tax and my last bit is inheritance tax. So again, thresholds are just being frozen. The level of tax taken, IHT, continues to rise substantially each year and hasn't changed and isn't going to change again. And again, don't forget, and more are gifting to charity. Some very substantial estates, they think it was enough that's going to their children, and obviously whatever you give to charity keeps you out of, well, that bit isn't taxed at all. The nil rate bands, as I've said, unchanged. The resident nil rate band, let me be clear, a question yesterday. If someone sells the property because they've gone into care, will they still get a residence nil rate band? And the answer is categorically yes. You've got to provide evidence of the executors that the wealth from the sale of a property is then still going down to the beneficiaries, but you don't need to live physically in a property at the point of death to get a resident nil rate band. So what you've got, each person's got 325,000 as a nil rate band when they die. If they own a property that is being gifted to direct descendants, children or grandchildren, you get another £175,000 between a husband and wife. That's why loosely it's £1 million. But just at the bottom you can see, be aware of this. If your estate goes over £2 million, for every £2 above that, you lose £1 of the residence nil rate band. By 2.7 million, you don't get that at all. You've just got the 650,000. And I'm not going to, in fact, we probably will be having a separate session at some stage with a solicitor on all of the routes with inheritance tax, because the interest, as the thresholds remain frozen and wealth goes up is getting greater. There's a lot you can do. The exemptions of 3,000 are the same since 1986. And I think if they're inflated, that would now be 15,000. The gifts out of income is a very big one, which more and more clients use. The small gifts exemption of 250, direct gifts of any size, but you live 7 years, contributions to pensions, contribution to your own pension is immediately outside inheritance tax. People forget that. Once you put your own money under 75 into a pension, we're doing more and more trusts where we set up a trust. There's no cost for setting it up. We'll manage that. That's the deal. And then particularly for grandchildren, you create a pot into which you're putting, whether it's one grandchild, 7, or a growing family, and you've got this pot of wealth, which then we're more regularly now dishing it out as the children reach 18, helping with student fees, helping with first deposits. And then there are also clearly business property relief schemes where you only need to live 2 years. And I mentioned family discussions. We were joking when in the old days, I haven't brought it up here, you've got the budget report posted to you. Many clients would come in the morning with it. There we go, Luke's got it. That is in the post, but we've also put this quarter's edition of The Investor in the post. And there's a great thing on family discussions. And you may have seen in the news, this is from the Mail online. I don't read that too often, but it was easy to get out. Just a case, literally, that's appeared through the High Court. So why is it in the press? Because it's in the High Court about a former soldier, interestingly, that died. He had 3 children. One had died quite some time ago. And basically, bar £50 to 5 of his grandchildren, it was split across his 2 children. Now, he lost his 3rd children quite some time ago, 3rd child. And that child, the 5 grandchildren have effectively been cut out of a will and only got £50 each. And the story is they never went and saw their grandfather. He'd been in hospital. They didn't see him for 10 years. And they took it to the High Court. So it went as far as that to try and change a will, and they didn't change a will. The point is, when I go back, family discussions, when you look at The Investor, look at the column, I can't remember, it starts on page 13. I think it's a brilliantly written thing, and it's also got things like WhatsApp, because it looks from the younger generation's point of view at your wealth and the discussions you should or shouldn't have about your wealth. One of the things that happens if you don't, you can have things like this. And certainly there is a significant increase in wills being challenged. So that is a fact. So these sort of things, as you go through your life, though we're British, so we don't talk about money and other certain things, but perhaps those with wealth need to do so. Only other things out of a budget, there's going to be this British savings bond, and we'll alert you to it. No rate of interest yet. It will be a 3-year bond, and we'll talk about interest rates later. So that will be launched next month. State pensions, we know the triple lock, the current government absolutely committed to. So £221.20 for the new pension, £169.50 for the older ones, going up in April. And I've put attendance allowance here. We've put that in our newsletters quite a bit. And we've seen a significant use of this allowance from our elderly clients, where one maybe is physically or mentally not so good, and the partner or the children are doing a huge amount and are eligible for the attendance allowance, or the elderly person is, which is not means tested, and it is tax-free. So you may have your own parents. You may be thinking this is something, talk to us about it, we can guide you. We can't complete it for you, but don't think that you're not eligible. The same goes with the blue badge, the disabled badge. So the tax burden is going to be the highest since 1948. Nothing's really changed for most of the audience here, bar you are going to pay more tax. Interest rates are a lot higher, so your interest is a lot more probably than the 1,000 allowance. So do look at what you need to do. John and I will be delighted to help you with it. So that was a budget, but I didn't really have anything to talk about, Luke. Great to see Luke here today. come down from Bedale. Many of you know him from Rowan Dartington, and Luke will tell you all about markets.
Morning, everyone. Tax burdens. Oh, it's depressing, isn't it? I think we were all hoping for a little bit more from the budget, but anyway. What happened to markets? I thought it was perhaps best to start with the slide that I finished or halfway through this time a year ago. It's always nice to come clean and see whether what we mentioned a year ago actually came true. And I think quite a lot of the things did. My one disappointment would probably be the opening bit on here, Ukraine and Russia. This time a year ago, the war had been ongoing for pretty much a year. Gas prices were starting to fall, but I think that we were all hoping that there would be a resolution by now. There isn't. For reference, Russia has elections coming up in a few weeks' time. I think we all know what the result of those will be. One of the concerns that I personally have is what Putin does in the lead up to that. He's someone who is somewhat of a megalomaniac in my view, and I think he has shown in his recent actions that he's not afraid to stand up to people, and I feel very sad about what's happening from a Ukrainian perspective. With the exception of those, or Ukraine, the other Brits, largely speaking, did come true and were reflected in investment markets and drivers behind markets. If we take a step back to this time a year ago, we came in pretty depressed, if I'm being honest. The expectation was that we were going to have a recession last year. The question was, how deep was that recession going to be? We'd closed 2022 with markets in pretty negative territory. So gilts have been hit hard by inflation. Indexes had fallen due to concerns about recession and the impact of inflation. The reality, though, was slightly more positive. I semi-blacked it out because I'm going to put some slides up here, but I think you will all be aware that last year was a positive year for investment markets. It wasn't plain sailing. This chart looked much easier when I was looking at it on my own computer as opposed to looking it up on a big screen. The red line at the top is the S&P 500, so 500 largest companies in America. Next one down is Euro Stocks Europe. Then you've got the MSCI All Country World Index, an index, broadly speaking, of the whole world. FTSE All Share, and then gilts down at the bottom. Thinking about those indices, and I'll go into it a little bit more about the driving forces behind it. Europe started the year quite strongly. That was on the back of really a warm winter, the fact that there wasn't an energy crisis that happened. So Europe started strongly. America was strong pretty much through the whole year. Some of that was down to AI, and some of that was down to corporate earnings. I'll touch on both in a minute or two. The UK was pretty lackluster until the final quarter of the year. The low point for most markets was in October, and then we had a strong year-end rally. Gilts again benefiting from that year-end rally. So I'm going to chat about some of the driving forces. So those major driving forces, I thought it would be easier to put them in probably a size order. Inflation and interest rates were the standout bit. The fear of recession, AI, China's reopening, and Japan's structural reform. Some of those are still prevalent today and still important today. So I thought I would whiz through some of those now. Inflation. I'm not going to dwell on this. You're all fully aware of what's been happening with inflation. The peak of inflation has definitely fallen. It's going to be harder from here to get the final bit of inflation down to government's 2% targets. I don't even know whether we will hit 2% targets. We could debate what happens with inflation for an awfully long time as we go forwards from here. Do also be aware that there are a vast range of inflation measures, whether that's PCE, core inflation, headline inflation, et cetera, they are all moving in the right direction downwards. Some of that is down to supply disruptions having alleviated. Some of that is down to excess spending. COVID lockdown savings have largely been spent. Some of that is down to money supply, and some of that is tightening by central banks. But inflation is moving in the right direction. And that should be positive for investment markets and continue to be positive for investment markets. The other, without a shadow of a doubt, driving factor last year was that fear of recession. Now, what do you do if there is a recession coming? On the whole, what people do is that they choose big companies. Big companies, on the whole, should be safer than smaller companies. We saw that from an American perspective. We also saw it in the UK. So I'm sure that many of you will have heard of the Magnificent Seven, the 7 largest companies in America: Apple, Microsoft, Nvidia, Meta, Alphabet, Amazon, and Tesla. They were driving forces behind much of the returns for investment markets last year. In Europe, we had the same thing, a wider group of companies, the granolas. Their names are on there, so I'm not going to read all of them out to you. But it's that recessionary fear. It's that fact that I want to be in large companies. One can all make an argument behind Apple being very important, Microsoft always going to be around. I'm going to touch on those a little bit more in a second. But those were the driving forces last year. AI was also a driving force. AI, in theory, will be transformational for all sorts of different industries. And I'm going to come on to AI in a second. It's very much a buzzword at the moment. It was also one last year. But before I do, or moving on and chatting about a couple of other bits, so China. China has a bearing within portfolios. People may not have direct Chinese exposure, but you probably have exposure to BHP Billiton, the mining companies, etc. China is incredibly important. The hope as we came into the tail end of 2022 was that China's reopening was going to give a real boost to the Chinese economy. We'd seen that in the Western world, so excess savings came out, we all made whoopee, everyone hopped on an aeroplane and had a wonderful time. China's reopening was very much a damp squib. So we saw this big rally into the start of next year that started to fade into February. And then concerns mounted. So there were concerns about what was going to happen with Taiwan, the property crisis, China Evergrande, etc., and politics. And politics is very much prevalent as we look at things today. I'm going to come on to it in a second, but there is a certain amount of friction between China and the West. Personally, I can't see that dissipating at any time soon. And that has had an impact in fund flows into China, or rephrase that, fund flows out of China. But on a more positive note is Japan. So Japan has been a widowmaker's trade for 30-odd years. Their lost decade seemed to last for 30-odd years, until Abenomics came along. That caused a slight, the 7 arrows, trying to reinvigorate Japan. But the real key bit happened from an investment perspective in the early parts of last year. And I'm not going to go into it in detail, but effectively the Japanese stock exchange took a fairly simple approach. They turned around and said, quite a few of you companies are far too cheap. You're trading at massive discounts to the underlying value of your assets. Unless you realize some value for shareholders, we're going to name and shame you. And Japanese people are pretty proud. I haven't been to Japan, so I'm just guessing a little bit here, but I think that they're pretty proud. And they didn't want to be on a name or shame list. So they thought, yeah, okay, we'll realize some value for shareholders. And that has been exactly what has happened. It's been this structural change that has resulted in a meaningful re-rating from a Japanese perspective. And the Japanese stock market has been performed very strongly last year. It's been performing very well this year. Now, currency has a bearing. I'll happily answer questions about the yen later. I'm not going to go off on a tangent on that now. But the question is, what is our outlook? What are our thoughts about what happens going forwards from here? What I've just given has been the easy bits, telling you what's happened in the past. Can I give you any ideas? If I had certainty, I wouldn't be here. But I think that the key bit is, what are some possibilities? Our base case from an economic perspective is that we're going to muddle through this year. Non-technical term, but I quite like it. It's easy to understand. Muddling through is GDP is somewhere flattish, depending on which region you're looking at, somewhere between -0.5 and +0.5. Pretty uninspiring, but it's not too bad. It's not a hard landing. It's nothing too depressing from that side of things. Inflation is falling back towards that 2% level, and interest rates start to get cut as well. If one was being positive, one would turn around and say that we've got a Goldilocks scenario, so economic growth is a little bit more positive, but that fall in rates becomes more significant. It's a very good investment environment for investing in. And in fact, this year, investment markets have started very, very strongly. So the base case is somewhat uninspiring, but fine. Uninspiring is good. Don't worry about uninspiring. The question is what happens with interest rates. This chart is, actually it looks easier to see on a big screen than it does on my computer. As we came into this year, there was a strong expectation that central banks would cut interest rates. And if we're looking at America, the Federal Reserve, Central Bank of America, their expectation is the orange line on the top. So broadly speaking, 3 interest rate cuts in 2024. Markets have got a bit excited back in December, though, and we're expecting somewhere between 6 and 7 interest rate cuts. It was feeling unlikely that we would have that number of interest rate cuts together with reasonable economic growth, and therefore people had got a little bit overexcited. If we were going to have 7 rate cuts, it was going to be because interest rates had caused severe harm to the economic environment. That hasn't happened. Markets are now expecting somewhere closer to the Federal Reserve's target of somewhere around 3 cuts. That's okay. Cutting rates 3 times, that would be quite nice. Nice and stable, uninspiring, muddling through. But cuts in interest rates will be positive. Not so good for cash savers, but good from an investment perspective. From a valuation perspective, America is expensive. I've been in investment markets for coming up for 30 years, somewhere around 30 years. America has always been expensive. Valuations are a poor predictor of short-term investment returns. They can be quite a good predictor over the longer term, although I would probably add that America has outperformed for somewhere around 30 years, and that valuation has all been expensive. But America is expensive. The rest of the world is very cheap relative to America. I'm going to come on to that in a second. You can see the PE ratios and how things stand from that side of things. But one of the reasons why America is expensive are those magnificent 7. So Apple, Microsoft, Tesla, and Meta. They had an incredibly strong 2023. That followed a weak 2022, but you can see I put on the returns year to date. The year to date ones are a couple of days out of date. NVIDIA so far, year to date up 74%. Now, the question as we came into this year was, could investment markets perform if these 7 companies didn't perform well? I think arguably we can say yes, because it's been the Magnificent 7, forget about it. It was last year's thing. You can see the returns year to date. Tesla is down somewhere around 30%. Apple is down somewhere a little over 11%. So we're seeing a disparity between the performance of these mega cap companies. You shouldn't just group companies together just because they're the 7 largest companies. There are phenomenal differences between them. Tesla, well, Apple is probably the most topical one at the moment. Apple's sales in China have been very weak. It's just been hit by a fine from the EU. There's questions about whether people are going to keep on buying Apple products. So Apple has been out of favor. It's looking fairly oversold at the moment. RSI readings are pretty negative, but so is sentiment towards the company. The sentiment towards NVIDIA is the complete opposite. So NVIDIA make chips, or they design chips. They've been a pretty good company. They've transformed themselves. They started off doing quite a lot with, they've done Bitcoin, they've done AI, they've done social media. They've done a lot of things like that. They've been a very transformative company. The share price is the blue line on here. And again, this is a little out of date. You can't keep up with the share price moves. You can see the blue line there. It's been a very, very strong run. The bit that's interesting is the dark blue line on here, which is NVIDIA's price to earnings ratio. Now, when you're looking at a share price, we'll have ones that go up like that. The bit that's interesting is your price to earnings. So NVIDIA's earnings have grown faster than the share price has. It seems phenomenal to comprehend that, but it has done. So as a result, the shares, despite having risen from somewhere around £2, or sorry, $200 to $700, have got cheaper on a price to earnings ratio. So it's quite interesting. Are those earnings going to continue? Expectations are yes. The company only forecast a quarter ahead, so they're not doing anything from that side of things. But AI is meant to be transformative, and that's what's causing a huge amount of enthusiasm to investment markets at the moment. Now, enthusiasm, unfortunately, towards us in the UK or here in the UK is not as good. So I just think it's interesting to take a step back, and all of you who have investment portfolios will have huge amounts of geographic diversification, but we live in the UK, and therefore it's useful to focus a little bit on it. From a productivity side of things, the table on the right-hand side, things aren't too bad. The UK is, since 2016, it's outperformed Italy, Germany, Japan, doing okay, middle of the bunch. It's fine from that side of things. On a price-to-earnings basis, the market has become incredibly cheap. It's back somewhere at about the same levels it was at back in 1992. I think the big question, though, is what's going to be the catalyst of a re-rating. So I chatted earlier on about that catalyst in Japan. So Japan had been cheap for 30 years, went through a catalyst of change, and we've seen a significant re-rating. What's going to be the catalyst here in the UK? So we have well-managed companies, broadly speaking, robust balance sheets, strong management. What's going to cause a re-rating? You know, we have little exposure to AI, so we're going to have to wait. Is the Brit ISA going to be it? I don't think it will be. That's just my gut feel. I shouldn't say that. I want to be more positive. I don't think it will be. We are seeing a huge amount of corporate activity that's happening. So there are a vast number of companies that are being bought out by either private equity firms or foreign institutions who are realizing the unbelievable value that there is in UK equities. There are lots of examples. Currys, the theoretical takeover value, is still only at it's about 0.6% of NAV. So in theory, the company could buy it, close down Currys, flog all of the assets, and almost double their money. So I think it's just interesting from that perspective. No one wants to buy it, though. We all want to go and buy NVIDIA, but there is real value from a UK perspective. Politics. I know better than to stand up here and start debating politics. What I can say is that there are a vast number of elections. There are more elections happening this year, impacting more people around the world than at any other time. Some of those are already a foregone conclusion. I touched on Russia a second ago. Two that very much spring to mind are our election and the American election. Again, I'm not going to go into a huge debate about the pros and cons of either of those elections. From an investment perspective, the UK election will not be, rephrase that, is unlikely to be a big mover in investment markets. There are more influential factors than what happens in the UK. It feels at this moment the odds are very much in favour of Labour winning, and that's the expectation from an investment perspective. Over in America, I'm not going to say things that I might have said. At the moment, it appears likely that Trump is going to win. They are neck and neck in the polls. We know what we've got with Biden. Biden came out with the State of the Union address last night. He's got to make it to the election. That's him. Trump, I think, is the more topical one. He's the one that investment markets are likely to. He's likely to influence investment markets more than Biden. Now, when he came in before, he was very much about giving cash away. He was pretty positive from an investment perspective. The expectation now is that he won't have the fiscal headroom to give away as much cash, or really give away any cash if he were elected. But like Jeremy Hunt, he hasn't got the fiscal headroom to go handing out cash however much he might want to. He's likely to potentially be inflationary, so he's likely to keep going with his tariffs against China. The the dislike that he has towards China, make America great again. Putting tariffs on tends to be inflationary, so that is the likely implication at the moment. There is going to be a huge amount of debate that happens between now and that election. There are all sorts of concerns about how fair elections will be, news flow, how true is it, how real is it? It's one, again, of those issues that we face towards AI. So we will have to wait and see from that side of things. Just as a final bit, there's a lot of noise that happens, a lot of doom and gloom, everything else like this. This is the MSCI All Country World Index. It's a pretty nice chart. Going back to 1988, nice steady thing, been lots of bumps along the way, but the general trajectory has been positive. That compounding of returns side of things, it's about being in there for the long term. We all get very excited about short-term market moves. What we really want to be doing is thinking about the longer term, good value, good investment, common sense, and most importantly, that financial advice, and trying to avoid the tax man where possible. That's it from my side of things. I'm going to pass you back to Richard. Thank you.
And when Luke talks about catalysts, I mean, he mentioned Currys. We were just talking, so Spirent's had a bid just last week. Wincanton's had a bid. DS Smith today will be in your news tomorrow. They've agreed an all-share merger with Mondi. Barrett last week doing a tie-up with Redrow. Nationwide this week, you may have heard in your papers probably today, buying Virgin Media. And then Currys rejecting a private equity bid. Direct Line rejecting a private equity bid. So that's 6 very quickly. There is beginning to get more and more recognition, whether it be in the UK or from private equity, that there is a significant value in the stock market, in the UK stock market. And maybe that could be one of the catalysts, but we'll have to wait and see. So I've got a rather delicate, I was trying to work out, I think I've done these for about 30 years, and my general reports, wide-ranging about what's going on, maybe a bit of global look, maybe some specific fund look. This one I'm going to concentrate on a less positive side for us, but to give you reassurance. There's been a number of announcements in the stock exchange from St James's Place, so I want to clarify what those have been. I want to make sure you understand what that impact is and why they're there, and then reiterate what it is that I believe that you are paying for. And then we're going to have an open question. There is nothing to hide, and obviously Luke will be here to deal with the market. So the first announcement that caused some turbulence, shall I say, in the share price was the half-yearly figures were announced in July of 2023. Very good figures, as I'll talk about in terms of new business coming in, but the share price slumped about 20%. And it was very simple. We announced that for clients in our pensions and bonds, there would be a cap on the fee of 1.35% once they get to the 10 years. So it's a loyalty bonus for our long-term clients. And the bottom line is our margin as a PLC was going to reduce. We were going to make less profit for the shorter term because we're cutting those fees by 10%. Very simple. The spin obviously wasn't very nice for shareholders, but it's great news for clients. And as we're going around and seeing clients, those that have been with us 10 years, and it's pro rata, so if you've done something 10 years ago, that's fine. If there's something 8 years ago, when that's done 10 years, that will have the fee reduction. So the fee reduction comes in at the 10-year point on the pensions and the bond market. And the reason we're doing this is there is more pressure from the Financial Conduct Authority generally and the industry to bring fees down. And this is an industry-wide thing, which is great news for the consumer. And this was an article referred to it in the FT about a month later, and putting a perspective on what both St James's Place were doing, but also the full market. And we are, as you can see, by quite some way, the largest wealth manager in the UK, but also in the fee space for advice, we're nowhere near at the top end of that. We're about middle range, and I'll show you another slide about that. And put simply, what the article's referring is that as the the largest, and dare I say it, one that can afford to do this, can afford to reduce profits in the short term, we believe for our shareholders and for clients, this is good news for the longer term. So the margin for shareholders, the profitability will go down, but we think two things will happen. We will retain more wealth for longer, and we will attract more wealth. And that was the premise that the board worked on, short-term pain for shareholders. And what we see here, and this was an article from Numis, which again we can share with you, and I have with a number of clients. It's looking at the advice space and charges, because what you see regularly in the financial press is that one, advice generally is expensive, and two, that St James's Place is expensive. And the first thing that we're trying to show is in the advice market, St James's Place certainly isn't expensive. And I'll come and talk about John and my model particularly, which is even cheaper because we don't tend to charge at the front end on any of your ISA and unit trust stuff. But in terms of the general cost of advice and the cost of implementing your advice, there are two ways to go. You could buy a tracker fund, put it on the cheapest platform, and do everything yourself. And that's what lots of people do, and there's nothing wrong with that. And you are cutting out the advice fee because you're doing it yourself. But as Luke was saying to me just earlier, which tracker are you going for? When are you going to rebalance it? Are you going for an all-weight, which means every stock's got the same value, or a weighted tracker? Are you hedging it back to the UK? There's lots of complications, which I think only when you've done it yourself for a number of years do you realize it's not as easy as it could be. But it is cheaper. And you've got to understand that the financial press is written fundamentally for people that like doing things themselves. And so they are right that advice is more expensive. And equally, it's John and my job to tell you what the cost and the value of advice actually is. And so we got to October, where we announced our third quarter figures. So like any PLC, the board go to the stock market every quarter and tell you how everything's going. And they decided they're going to make another announcement. This was the unbundling, as it's called, of our charges going forward. And again, a little bit of this was in the Investor that was published just after Christmas, and we'll be telling you more about it. And again, I don't want to be overly complicated, but very simply, if you were to go out in the marketplace to AJ Bell, Hargreaves Lansdown, or any platform like that, you have effectively three sets of costs, as I've put down here. You've got the platform cost. Whoever you're buying that fund or that share, they will have a cost, or the stockbroker cost. You then have the actual underlying fund cost. If you're buying a Fidelity or a Schroeder or a Jupiter fund, that will have a cost. And then if you're getting advice, that advisor will have a cost as well. Now, with St James's Place, since the 2nd of January 1992, when we started, we've had it all as one. And we declare, and in your wealth accounts to the pence, you see what that cost is every year. And it's all together. It's simple and it's easy. But the fact is, when you're now more and more trying to compare how Fund A has done to Fund B, if Fund B with St James's Place also carries with it on its back an advice cost and a platform cost, and you're only comparing it to one element of the cost, a fund cost, it's complicated, it's unclear. And that is why we're just going to unbundle those costs by the summer of next year, so there will be three sets of charges. And the combined set, our commitment, will be fractionally lower. So that announcement went down really badly with shareholders. We're cutting our margin again. We're going to make less profit because we're going to charge a little bit less. And again, you get the scary headlines and competitors jumping on that. But we can afford to do it. Last year, £15 billion worth of new investments came in from our clients, and we think we'll go through over 1 million clients in the current year. So despite these changes, which we think are for the good for our clients long term. They're clearly hurting the share price, but we believe it will be right in the end for our shareholders. And so I move on to 2 weeks ago, last week, I lose touch, where we made our profit announcements for the whole of 2023. So this is where you report not just your new business figures, but profitability. And again, it was a very good year for profitability, but we made a significant announcement on ongoing advice fees. And the correlation with this is, again, the good old FCA, the Financial Conduct Authority. And what's happened just recently, it's been in some papers more the FT than anything else, they are again really cracking down, not just on the advice industry, but all the platforms. And they write what are called Dear CEO letters, which are how they want businesses to run under their guidance. So one area that's nothing to do with us, as an example, is if you're on a platform and you've got 10, 20, 30, 40, 50,000 pounds in cash, not only is the platform taking half of the interest, but it's charging you to have that cash on the platform. It's called double tapping. That's not really in the interest of the consumer that goes on, so that's having an effect on the platforms, which is why you see Hargreaves Lansdown and AJ Bell's share prices also struggling. With the advice industry, quite rightly, what they've done is they've said, we want to check that the ongoing advice fee that you're paying for people like John and I is something that you've actually been received. And the bottom line, and very worryingly for me, it is clear that some of our colleagues haven't been doing these sort of things. They've been charging an ongoing advice fee in the last 4 or 5 years, and not in all cases have they actually been getting that advice. And that's what the FCA wants to do. And so what St James's Place have done is they've put a provision in the accounts to cover for the advice fee that wasn't actually warranted. And that will be going back to our clients. And we've started a process where this will now be undertaken, will be reviewed, and clients will be written to, and where it is appropriate, if they didn't get that ongoing advice, they will be repaid the fee that they were charged to not get that service. And again, let me be very clear on this. This says it clearly. We're one of 20 firms that have been written to. We are the first to act on this. We are the first to make a provision on this, but we will not be the last. It is not a unique thing, and it is perfectly fair. I absolutely endorse what the FCA are doing. I endorse what our board is doing. If you've been paying a fee for a service you haven't been using, why should you pay that fee? You get into difficult waters when certain journalists then say, well, hold on, I didn't look at Netflix last month and I paid my fee. And some of our clients don't necessarily want to see us too frequently, but if you're paying for it, we've got to provide that service. So again, there is short-term pain for the shareholder who's had 3 hits over the last year. And let's be clear, the share price with shares that people like Luke, John and I have got has gone from about £11 to today just under £5. So there's been a significant hit in what is the perception of the value of the share. And the dividend has also been cut because of a provision. But again, if you look at what the market is saying and what our analysts are saying, 1, we will not be alone in this, and 2, if this helps retain our clients and attracts more because we're more competitive on cost and so on, we think that the future is bright. And let me be very clear, as I'm about to show, what is value? Because you can talk about cost, which I've just talked about, and what shareholders have to worry about. But then the perception is, what are you actually paying for? And this is a judgment you've all got to make. And possibly I'm talking to the converted, but again, you don't see this clearly as much in the press. And I'm not going to over-dwell on it. But number 1, hopefully you get some tax advice from John and I. That's why you're here. That's why we've got a lot of people watching on YouTube. That's one of the top things on our agenda. How can we help minimize your tax? And the work we've been having to do, and Luke very much with CGT's exemption in the last quarter of the tax year, is just going up and up and up, and the amount of tax we've saved by making sure we're using our clients' CGT exemptions every year is absolutely staggering. And if you haven't done that, if you're not advised, people don't do it. It's as simple as that. They don't do it. They don't know their base price, they don't know what their capital gains position is, and they don't know what they're going to sell and what they're going to buy. And obviously inheritance tax is another. So you've got the tax advice, that's one element. And pretty much John and I and many of my colleagues can actually quantify the value of that tax advice. The investment advice, again, it's harder to quantify, but clearly what are your own benchmarks? And that's very unique to every one of you. You've all got different risk profiles, you've all got different levels of income, you've all got different outlooks, objectives, and so on. But our core aim is to make sure we beat inflation and beat cash, subject to the risk profile that you're obviously undergoing. And as Luke's been saying, a difficult year in 22, a difficult year in 18, but pretty much since the financial crash, the objective of certainly beating inflation and beating cash has been easily achieved. We will have difficult years going forward. I always say in a 10-year cycle, expect 3 negative years. That's the nature of the stock market. And I think we've been slightly misled by central bank intervention, by a lot of government intervention in propping up economies through things like COVID, post-Brexit, inflation, energy, that we've been sanitized from volatility. And I think that governments can't afford to sanitize us from volatility. Luke may disagree with me on here. And that's why I think we're returning to more typical events. But I move away. And I just want to show one of these, and it's hard to read, but I've shown this before, so it's just, I'm being consistent. This is a former fairly senior banker, and this person has been with me for about 30 years. And what the red line shows is that this person's total investments, less what we've paid away, are now minus £117,631. I.e., if they had invested £100,000, they've had paid away to them over £217,000. And this person, with this person's partner, leads life to the full. Let me be clear. Life is for today. It's not about saving for tomorrow. There's a good bank pension, but it's also doing things. And that's a great piece of advice for all of you. And despite that, and also I should add, there are no children. So they don't worry about saving money and putting things for the future. The blue line shows that the current value is 208,000. And it's wobbled about a bit. They don't need it to go up, but it's broadly in that 10-year space maintained its own value. And this is a person from North Yorkshire that I was with just last week, who was getting a hard time from her son, who likes doing his own thing, and saying, why do you need to pay for advice? Why do you need to have investments helping you that are very expensive? And what that lady and I have worked out is that she likes looking after it and actually dealing with her own son, and runs a self-select portfolio of UK individual shares. And what she'd asked me to do, and she needs income, was to make sure that I ran a more global portfolio that gave income but didn't do what our own portfolio was. And so it was interesting. So we quickly looked, right, how have you done since you came to us in 19? So it's only relatively short compared to the UK market. It's a bit of what Luke's been talking about. It's not boasting about performance. It's highlighting that the all-share index has not done so well, which is a darker blue line, growing by 25.3. It is actually the fact that globally, particularly America, but also Europe, in her portfolio, have outperformed the UK market quite substantially. And what was interesting was her son was giving a view that was the complete opposite. Factually, it was completely incorrect. So that's helped her understand, or shall I say the son, better understand the value that hopefully John and I and Luke provide. And I say drawdown advice. Drawdown is often a word used for pensions. But most of you are in drawdown, or you should be. You've saved all your life. You are at the stage where you need your capital, both to protect you against the future and a bump in costs as care comes along at the end of your life, but to have a good time now. And with inflation rising 20% in 2 years, more of you are reliant on your capital. So how do you use your capital to help you complement your standard of living? And that's, again, a value that John and I add, whether it's giving you amounts you should take out, whether it's a method you should take it out, how to monitor it and make sure you're doing it sensibly, not selling at the wrong time and you're using all the exemptions. With pensions in particular, you need quite a lot of technical help. And then obviously there's the legislation, whether it's be CGT, the changes to the pension legislation with lifetime allowance going, and now taxing you on pension lump sums depending on the amounts, all changing. And that's before then we talk about what Luke's covered, the investment advice. St James's Place has 49 now different and independent investment managers. There were about 8 different managers appointed who were new last year, of which about half were not available to other retail investors in the UK. And under Tom Beale, the ex-Pocklington boy, still our top man in the investment, I can only say I'm more confident about the investment side now going forward than I have been for a long time. And again, you got the surveys last year that talked about St James's Place performance. And for those that did ask, we produced a great document on the Spot the Dog, as it's called, survey, which again has just come out, which were not featured in this year. And it highlighted 3 years ago how in the 11 sectors of Spot the Dog, the pedigrees, who they recommended, did against the dogs. So this is a survey that came out 3 years ago. And it then said, how have, in the next 3 years, right up to date, the pedigrees done compared to the dogs? And in 11, of the 11 sectors, 10 of the dogs had outperformed the pedigrees. And if you just invest, and again, Luke's point, on the basis of what has done well, believing it will always do well, particularly in a more general fund basis, it's a very, very dangerous way. So we hope that the investment advice, we add value. And I just show here, it's a multicolored Joseph's coat here, isn't it? It's hard to tell, and I'm not going to do it, but it's just saying the different sectors, what has done well each year. And I've got no idea what will do well next year. Just because America did well, will it do well? When I started in 1987, there was one market to invest in that was 60% of world stock market capitalization. It was a little island. It was called Japan. And guess what's happened? Japan peaked in 1989, and therefore 34, 35 years later, it's just gone through that peak. So going into something because it's big and has done well can be very dangerous. And then just to end, what John and I try to do is then look at the general picture. Sometimes I think we feel we're shrinks and we're trying to help on the wider matters, but if it allows you to have discussions about family matters, about history, about your own parents, and therefore the things that affect your thinking, that's essential. And what we always say is, let us help you ensure you are using everything to make the best decision, all the factors. And if that's us telling you to go left and you go right, it doesn't matter. It means that it's a better and more well-informed decision. So again, whether it's fixing or going variable, and again, that's very relevant right now. Luke's just said 3 base rate cuts. Is that right, Luke? 3 base rate cuts, which is consensus clearly. So hold on, rates are going to be lower in a year's time. Should you fix, perhaps, some of your money at a rate that won't go down? That means you won't be able to get at it, but it could be very sensible. We've got a cash management platform that is really useful for people with large sums on cash that don't have to go around with your passports, driving license, bank accounts to every bank. Obviously helping the family trusts, pensions, grandchildren, investment for minors. And then the other thing that our chief executive said just last week, with the offices that we've got around the country, like ours in the Stables just 3 miles from here, we now have a higher office presence than the largest high street bank in the UK. We're going the complete other way to branches in banks in particular. And there will be actually a nationwide advertising campaign, which I gather will be on television, highlighting just the difficulty in getting appointments. And I hope it's not going to be too negative on doctors and the NHS, but it's talking about getting appointments. And the policy that we run is that you have a human being picking up the phone. It's as simple as that. They pick up the phone, they will give you their name, they will give you their direct line, and if they can't get an answer straight away, they'll commit to at least giving you a call back and then following it through. And we're passionate about that, and that's the ethos of the whole organisation. If you're going to pay a charge, as you are, you need a service, you need value for that service. So again, I'm not trying to preach to the converted, but I'm trying to emphasise what it is we as a group believe that we try to do. And I mentioned here little things, attendance allowance, credit shortfall when maybe your children, your daughter particularly, she's brought up children, making sure people get the full state pension. Again, helping people when they sadly lose a loved one, getting information quickly, making sure they pick the right solicitor or they do probate the right way, they get the release, making sure we transfer things quickly. So there's no cost whatsoever in transferring the pension, the ISA, the taxable portfolio over from the deceased to the surviving partner. Making sure, particularly lasting power of attorneys, so important these days that you've got that. Again, government bodies are not the quickest at the moment. Dealing with the Office of Public Guardian is not that easy. And facing deputyship, where you lose capacity and you've not got a lasting power of attorney, is an absolute nightmare and very costly. So if you don't trust someone else to do it, someone will do it through deputyship. There is a legal process if you lose capacity. And I think the last one, what is value? How can I quantify value about giving peace of mind, about answering questions, about admitting we don't know the answer but we'll find out, about, as Luke has talked about, not just following one market because it's done well, one share, having balance. And what is, again, a clear fact is advised investment clients, when the surveys show, outperform non-advised clients because they are less emotional about their decisions. They stick and they don't sell at the wrong time or buy at the wrong time. So there's a big mixture. I've deliberately tried to be as honest and as open as I possibly can about the announcements which have caused the share price to fall. It has got absolutely nothing to do with your individual portfolios. Your managers are restricted and not able to buy St James's Place PLC shares, so you are protected in that incompletely, which is why the returns we've seen in the last 12 months when that price has gone down are completely unaffected. And I hope that you can see that the range of things we go to, and frankly, John and I, if we just gave simple advice on investments, would be bored to tears. It is the rounded advice, the holistic advice that keeps us going, and there is a cost to it, and we are absolutely passionate about making sure you get that. I deeply regret that clearly some of my colleagues haven't done that, but their clients will be redressed. So it is corny, great for private clients. I looked at it, I thought, do I really want to put that? But when I look at what we're providing, and I then look at any of my clients and being able to say, you're paying less now, thank you for your loyalty, you're paying less, and each year that goes on for our clients in the pensions and bonds, you'll go through that 10-year stage, and by the summer of next year, we'll be able to again look at all of you and say, now we've unbundled, you'll see very clearly that you'll pay less, and the service we provide hopefully will be maintained. So, let's get some questions. I'm sure there are some, both on the budget, not that there is much, anything on the investment side, which we'll try and defer to Luke. We're running reasonably well. I will try and end it at midday. I know people have got lunches to go to and things. And what we've got to do, because we're on YouTube, I will repeat the question because I've got the microphone, and then the listeners will be able to hear it. And then between John, Luke, and I will attempt to answer it. First question, anyone? I've got to put my specs on so I can see. Well, this is. I'm not sure. There we go. Yeah.
Richard, I'd like to ask Luke. I think everybody's very interested in the AI and the impact it can actually have. Have you? I don't know whether you saw Dragon's Den.
No.
The immediate nexus, and I wondered whether you'd tried the system and what you thought of it.
We've got a real problem here. Just to repeat the question back, it was a question relating to AI and a product that featured on Dragon's Den, which unfortunately I didn't see. So I'm going to really struggle to answer the question. I'm presuming that the question from a more broad perspective is, what is the impact of AI? And I don't think any of us can answer that yet. The transformation of, if we go back 15 years ago, somewhere around 15 years ago, mobile phones came out, and then they decided that they were going to put cameras onto mobile phones. And I was listening to a fund manager chatting about this, and he turned around and said, well, that was his biggest investment mistake that he ever made, because he thought that this was a complete waste of time. Why would anyone want to have a camera on their phone? What we now figure out is that people have a phone on their camera. People are just going around there taking snaps, whatever they are. And innovation causes change. We saw the Chancellor talking about the need for an increased productivity here in the UK and whether AI can help from that perspective. I think there's a lot of hot air to a degree. Personally, I don't know how ChatGPT really helps. It's brilliant. I can write a wonderful poem to my mother on Mother's Day and it just wangs it out just like that, and it's brilliant. But that doesn't really increase our productivity. Productivity benefits will come from AI. We are arguably at the very beginning of a transition and a journey, and we don't know where it's going to go. Going back to what Richard and I were saying before, it's important to have diversification within portfolios, and then exposure to AI would be great. What happened on Dragon's Den, I don't know, so I can't answer the exact question, but I've skirted around things. Pleasure.
We'll connect maybe with, I don't know if it was in the financial world, or was it more general, the particular?
It was a method of investing small amounts, and it was using stop losses, and it was going up and down in the marketplace, and the algorithms, generating the cash.
Yeah. And I think the other thing is, in the fund management industry, there are well-advanced quant methods and many different methods that are using, I guess you could call it AI, but they've called it different theories for many years, some of which have proved to be profitable, some of which haven't. So I don't think it's new, and it may well form a greater part of it. Any other questions? Yes, Mr. Christie.
Do you think the industry, the financial industry, if you like, is adequately protected against the malware aspects, if you like, of AI? Because it seems that no one really knows what effects it's going to have, and yet there are instances like the sort of everyday things, that people are conned into things. And is the industry sort of protected against that? No one seems to know this at the moment.
Yeah, I mean, I'll give you my first answer. The thing that kept my former chief executive officer awake more at night was any form of technological disaster, whether it be someone coming in and getting hold of data, And the money that is being spent by industry around the world protecting itself is huge. So I think it is out there as a concern, and you get quite often little announcements that your data's been snatched, and it's a real worry. And I would like to think that we are taking that incredibly seriously. But you are right. Any advance in an area we're not aware about, there are good things, productivity, there are bad things. I don't know if you want to... Sorry, I didn't repeat the question.
So I won't repeat the question. I'll try and answer the question by referring around it. So Richard chatted about the protection of your money, which is paramount, and that security aspect is one bit. My interpretation of your question was, are investment markets influenced by fake news, AI? To which the answer is yes. So there was a case last year where someone had faked a photograph of a bomb going off on the White House lawn. And investment markets fell very rapidly, unsurprisingly, for a period of time until it was announced that this was just an AI-generated photo and a bomb hadn't gone off on the White House. That is a trend that I suspect will continue. There is more regulation that is coming about, so we're getting into quite specialist areas here, but there are regulations, I believe, I've got to add the I believe bit or someone will sue me, coming in before the US election to try and make sure that AI-generated images, etc., are labelled as such, as opposed to it appearing real. Yes, it's going to keep on happening. Has it happened before? Undoubtedly. Propaganda can be used for both the good and the bad. The question is what is true and what isn't is going to remain, and it's going to become ever more of a question as media influence increases. I'm sitting there with two phones. They go beep at me. Someone else's phone went beep earlier. There's news 24 hours a day, and there isn't 24 hours worth of news, and therefore fake news speculation will keep on increasing, sadly.
Yep, so the question was about the British savings bond starting April 24, run by NS&I. What rate of interest will it need to be attractive? So base rate's 5.25 now. In the old days, if you're fixing the rate of interest, you hope to get a better return for locking it up. And we've got to presume you will have to lock it up. But at the moment, if you fix out to 2 or 3 years, at best, you're getting a lower rate than you can now, around the 4.5% area. So you've got to give up some return now to guarantee it's not going to go down. The second part of it is it's all about the funding arrangement for NS&I. It's all about how competitive they have to be and how much money they've got to raise for the government. And I think they've said it actually not horrendous. I think it's something like £9 billion for the next financial year. So we will have to wait and see, because you can get very attractive rates from NS&I. You can get unattractive rates. The key, Jean, is to make sure when it launches, you speak to us and we'll tell you what you can get in the market. So, I'm not necessarily saying fix out for 3 years just because there's an NSI product. I am quite keen on clients looking at 2-year fixes, because I think if you fix just for 1 year, you'll see some short-term gain. I think the Fed announced yesterday they're closer to interest rate falls in America. We will follow, but on the basis 3 base rate falls, we could be 4.5 this time next year. So if you fix just for that year, you'll come out at a lower rate, but then you can't access. So, do speak to us. We'll see what it is. We'll publish what the rate is. And make the comparisons. Time for one more. It's 11:58 according to my watch. Yes.
You've painted a picture of SJP today, where it's a positive-looking company for the future, very low share price. Is there a risk of a
welcome or unwelcome bid for SJP?
The question was, given the share price of St James's Place, is that a risk of a takeover? And there is a committee that's been in existence for a year all about that. Ultimately, there is a risk if any share price goes down and there's an intrinsic value. Our funds are at a record highs. Our revenue has never been higher, and our share price has fallen substantially. So you're entirely right, and it is the duty of a board, and they have undertaken it, to make sure that they are fully ready should anything like that happen. We don't think it will happen, because ultimately they're not buying plant and machinery and factories and patents. They're buying your ability to retain funds, and they're buying John, Luke and I's ability to attract new funds and retain funds. And they're quite movable feasts, I should say, both from your point and our point. So although there is a risk, compared to some other industries, I think it is relatively low. But to dismiss it would be entirely wrong. Brilliant. Thank you for your patience as always. It's a great privilege to see you. We have your feedback sheets, only really relevant if you have either something pre-year end or post-year end, or have something. So just spend a couple of seconds, minutes or whatever. But apart from that, great to see you. I hope it hasn't been too inconvenient. Some people like coming here because the parking's easier and you don't have to go up the Weatherby Road and so on. John and I very much around, all the teams around, so don't rush off if you don't have to. I hope we get through this winter. Generically, it does seem like it's been clearing on for ages. You can hear the east-north wind blowing through here. Great to see you. Safe journey home, and get hold of us at any time. Any questions, any concerns, we'll be there to answer them. Thank you very much. Thank you.